And now we come to trade of the day, the highlights of this week's trades. Let's get into it. Good evening and welcome to Follow the Money, bringing you the latest updates on everything finance, business, the markets, and investment funds. Our top story this week, we're uncovering a major investment that's hitting all the right notes in the music industry. Private equity titan Apollo Global Management has just invested a staggering $700 million into Sony Music Group. This deal highlights a growing trend where investors are increasingly looking beyond traditional assets such as stocks and bonds and turning into alternative investment. The booming demand for alternative investment has turned the music industry into a hotbed for Wall Street financial heavyweights. With streaming rights and the steady cash flows from music royalties, the music industry has become a magnet for significant capital. This isn't Apollo's first foray into the entertainment investment. Back in 2021, they also supported Upperview Equity Partners, a firm specializing in media and entertainment investments. Apollo's major investment in Sony Music is a clear indicator of how financial powerhouses are capitalizing on the music industry's potential. As streaming continues to reshape the landscape, keep an eye out for more significant moves in this space. Also on Follow the Money, we're dissecting New York Community Banks Corp's recent turmoil and how its exposure to office real estate is affecting its bottom line. New York Community Bank Corp reported a disappointing second quarter loss that surpassed Wall Street's expectations. The bank set aside more funds to cover potential losses related to its office and multifamily loan portfolio, resulting in an 11% drop in its shares. The decline in occupancy due to the rise of remote working has put pressure on the bank's office loans. Additionally, the high interest rates are exacerbating the bank's challenges. The bank's provisions for credit losses surged to $390 million, significantly above the anticipated $210 million. CEO Joseph Alton mentioned that the bank is actively seeking to sell between 2 to 5 billion in loans. Despite these efforts, a stock rout following a surprise loss and dividend cut earlier this year has diminished nearly two-thirds of the bank's market value. In response, the New York Community Bank's unit, Flagstar Bank, is selling its residential mortgage servicing business for $1.4 billion. This move aims to bolster the bank's capital and reduce its exposure to volatile interest rate environment. The sale of this unit is part of New York Community Bank Corp's strategy to shift focus towards commercial and industrial lending. The bank also recently sold a portion of its loans to JP Morgan Chase in line with its goal to offload non-core assets. The bank's struggle with office real estate and rising credit losses underscore a broader trend in the financial sector. As the bank navigates these challenges, its efforts to offload non-core assets and refocus on new lending opportunities will be crucial for its recovery. That's all for Follow the Money this week. Thank you for joining us. Join us again next week in the latest updates in the world of money. Back over to the studio for Trade of the Day. Welcome to Trade of the Day, our groundbreaking weekly trading series where we reveal the secrets to achieving consistent weekly returns in the fast-paced world of day trading. Join us every week on this exhilarating journey as we decode the strategies and mindset needed to harness the power of the markets and unlock remarkable financial growth. Whether you're a new trader seeking to build your wealth or a seasoned investor aiming to amplify your gains, our series is your roadmap to success. Get ready to revolutionize your trading approach and embark on a path towards achieving your financial dreams one week at a time. Also, we'd love to know where in the world you're tuning in from, so post in the comments below. A reminder that this is not financial advice and that trading comes with real risk. My name is Alice and I help traders and investors who struggle with confidence to make money in the financial markets, find consistency and scale to achieve financial freedom, time freedom, and location freedom. I believe trading is the greatest wealth building tool of all time and everyone on this planet needs access to this skill. I'm on a mission to impact 1 million people through trading by 2030. Woo! Let's go. Coming up this week, this is how you could have made 5% in the market, taking one trade a week, using one model, risking no more than 2% of your equity, looking to make a 1 to 3 risk to reward. So you're risking 2% to make 6%. We had a total of 3 trades this week for a potential return of 18%. Wednesday's trade didn't count as it would have been tagged in post-trading hours. No entries post 3:45. That's what the plan states. Also, it's important to know that everything that we share here is how we trade at I'm the Trader. But before we dive deep into this week's trade of the day, let's talk about having a trading edge and what that entails. A trading edge is one of the three pillars every trader must have in their trading to survive and thrive in the financial markets. If you don't have these three pillars in your trading, you're setting yourself up to fail. Confidence in your trading edge comes from three things. One, understanding the market and how it operates. Two, having one trading model that has IPTA signatures. Three, having a plan and process that you follow every single day. Successful trading is boring. You're doing the same thing over and over again. This is the three-step process I use to take trades weekly. Step one, condition. This is based on the high time frame directional bias. Step two, stage. What sets up your trade? What does it look like? Step three, execution. Can you execute? Have your entry criteria been met to get in that trade? The most important step is step two, the stage. Because once you understand where the market is going and you understand the setup, the entry is easy. Also, guys, if you understand price flows that occur around key highs and lows intraday, you'll have everything you need for a setup. A little nugget for you free of charge, all right? Step one, condition. Determine the high time frame directional bias. Where is the weekly candle likely to go? What is it reaching for? This will give you your condition going into the week. There are several factors that go into determine the high time frame directional bias. However, there are only two options. Is either you're expecting the weekly candle to expand higher or you're expecting the weekly candle to expand lower. Step two, stage. What sets up your trade? What does it look like? First, we look at the economic calendar for the week. It lets us know when to look for a setup. We stalk setup on calendar day and after the news release. The optimal days to trade this week were Tuesday, Wednesday, Thursday, and Friday because those were the days we had high to medium impact news. Secondly, we look at what sets up your trade. What does it look like? This will be your model. If your weekly analysis suggests that price is going higher, then you're in a buy program and should be hunting long formations. For our buy model, we want to see price trade below a key low, displacement higher causing a market structure shift. Displacement leg must have a fair value gap busy near the swing low. We wait for a swing high to form to anticipate execution. If your weekly analysis suggests that price is going lower, then you're in a sell program and should be hunting short formations. For our sell model, we want to see price trade above a key high, displacement lower causing a market structure shift. The displacement leg must have a fair value gap SIBI near the swing high. We wait for a swing low to form to anticipate execution. Step 3, execution. Once the stage is set, when and how do you execute? For execution, we're looking to enter on the fair value gap or order block created in a displacement leg that caused the market structure shift. You have two options here. You can either enter a limit order at the fair value gap or limit order at the order block. We use the fair value gap near the equilibrium of the range. You can also use the low hanging fruit option, being the one closest to price. The stop loss will go at the swing high for a sell, at the swing low for a buy. We're always going to be targeting a 1 to 3. It's important to know that you can have both models form in a span of a day or a week, but your high probability trades will be in the direction of your weekly program. Here are some factors to consider for high probability setup. First, we have time, the most important aspect of trading. At what time is the setup occurring? Then we have range. Where are we within the range? Are we in the upper, middle, or lower quadrant with respect to buy or sell? Liquidity. Is there or does price create liquidity right in front of the fair value gap or order block? With regards to this liquidity, once price takes the liquidity and enters the fair value gap or order block, you should see an immediate reaction. Lastly, when can you no longer enter the trade? Where is your cutoff point? For me, once price leaves the 0.25 fib extension, I'm no longer interested in entering the trade. You have to understand that trading is a solo sport. You have to make it unique to you and your personality. All of this sounds complicated, I'm sure, if you're hearing it for the first time. But it's really simple. You just need to keep showing up on the charts and look for it. Now let's head over to price action and look for it in price this week. Welcome to Tracking IPTA. This week in trading brought a series of valuable lessons. Despite experiencing a series of losing trades, the week provided crucial insights into my approach. After analyzing my trades, I realized the importance of diversifying my entry timeframes. Previously, I focused primarily on the M1 timeframe, but now I understand that my model is not always going to be visible on this short timeframe. I've discovered that the M5 and the M15 timeframes can also offer excellent entry points. Although the week was full of double losses, it has significantly enhanced my understanding of my trading model. By expanding my time frame analysis, I am better equipped to identify opportunities and make more informed decisions in the future. I finished the week with 11.5% decrease in equity. In dollar signs, we're talking $2,880. And overall, we're up on the account by 34%, which is $8,505. Let's get to hunting, guys. Grab your tools. As always, we'll be looking at the charts in bar replay mode. This means that you won't be able to see my executions. However, you will be able to see my horizontal lines, which represent the time aspect of trading, the most important tool you need to track IPTA's movement. Now remember, even though I'm going to show you both buy and sell setups, it's important to know that your high probability trades will be in the direction of your weekly program. You can take counter trend trades with this model. For example, you can take sell setups even if your high time frame direction is bullish, and vice versa. It's just that your probability of winning reduces significantly when you go against the high time frame directional bias. If you're new to trading, I do suggest only taking trades in the direction of your weekly program. We're going into this hunt with the understanding that you guys have already arrived at your high time frame directional bias. This is a hunt purely for setups. To the hunt, let's go. Tuesday, July 2023, we had a PM session sell formation with the entry on the M15 time frame. Let's get into it. As you can see, in the morning session, we had price trade above a key high. We take liquidity above a key high. Displacement lower, causing a market structure shift below the key high. The displacement leg has a fair value gap SIBI near the swing high. We wait for a swing low to form to anticipate execution. For execution, we're looking to enter on the fair value gap created in the displacement leg near the equilibrium of the range. I've come to realize with the higher time frames, you're looking for the one closest to the 50% range, okay? So here you would have been tagged at the consequent encouragement of this SIBI right here, and you would have been tagged in this trade at 2 p.m., breaking even at 6 p.m., taking out the trade at 3 a.m. Would have held it overnight, okay? For a total time of 13 hours in this trade. Drawdown in this trade was minimal, was 32 ticks for a 6% bagged and tagged. Let's look at factors that made this trade a high probability to set up. First, we had the time aspect as the PM session. You enter in the PM session. Check. Range. We're in the middle to upper quadrant of the range. Check. Liquidity. We have a short-term high right here. The price comes and takes 3 out of 3 matching up to make this a high probability trade and netted you 6% for the day. Wednesday, July 24th, trade of the day breakdown. We had a PM session buy formation with the M5 entry. This trade would not have counted due to the fact that the entry would have been tagged post 345. And according to the plan, we're not looking to be in the market after 345. The entry is not tagged at 345 or prior, and the trade is nulled, okay? We're not getting in that trade. But let's get into this trade. We already had the news come out in the morning. As you can see, PM session starts. We trade below a kilo. We take liquidity below a kilo. Displacement higher, causing a market structure shift. Above the kilo, the displacement leg higher has a fair value gap BISI near the swing low. We wait for a swing high to form to anticipate execution. For execution, we're looking to enter on the fair value gap created in the displacement leg near the equilibrium of the range. So you would have been tagged in this trade. Well, you would have been tagged in this trade at 350. Hence why we don't get in this trade. But would have been tagged in this trade at 350. You don't get to break even. You're taking out 5 minutes later for a total time of 5 minutes in this trade. Drawdown in this trade was 179 ticks or a 2% loss, all right? Even though you took a loss, let's consider factors that made this trade a high probability to set up. First, we don't have the time aspect actually, so it doesn't make this a high probability to set up, hence why it resulted in a loss. So no time aspect, the range, we are in the middle to lower quadrant within the range. Liquidity, no liquidity in the 5 minute setup right here, but we do have an M1 liquidity that it comes and takes. So 2 out of 3 matching up to make this a high probable trade because the time aspect is the most important aspect of trading, okay? If you don't have the time aspect, then you have no business being in the market. So this is a time where the plan would have actually avoided the loss. So that was the trade of the day. I wanted to include this to let you guys know that even though the setup is there, if the timing ain't right, your probability of winning reduces significantly. Thursday, July 25, we had a PM session sell formation with the M15 entry. Let's get into it, all right? So lunch session, we had price trade above a key high. We displaced lower, causing the market structure shift below the key high. The displacement leg has a fair value gap SIBI near the swing high. We wait for a swing low to form to anticipate execution. For execution, we're looking to enter on the fair value gap near the equilibrium of the range. And like I said previously, on a higher time frame, I'm saying M15 entries. I've noticed that you want to be getting in below the 50%, all right? Because it might not be trades high enough to offer you that entry on higher time frames, okay? So you would have been tagged in this trade after this candle closure would have confirmed the swing low. So you would have been tagged in right here on this candle, would have came back up the low of the SIBI. So you would have been tagged in here at 2 p.m., breaking even at, I don't have it on here, so that's why, breaking even at 2:45, taking out that trade at 3:45 for a total time of 1 hour 45 minutes in this trade. Drawdown in this trade was 35 ticks for a 6% bagged and tagged. Let's look at factors that made this trade a high probability to set up. First, we have the time aspect. We're entering in the PM session. Check. The range. We're in the middle to upper quadrant. We're in the premium for a sell. Check. Liquidity. We have a M5 liquidity. That price comes and takes into the M15 SIBI right here. The short-term high. The short-term high right here, the price takes. And once it takes that, you see immediate reaction to the downside. 3 out of 3 matching up to make this a high probability trade. And netted you 6% for the day. Friday, July 26th, we had the AM session buy formation with the M5 entry. Let's get into it. So the morning's AM session start, we had price trade below a kilo during the opening range. It was a London session low. AM session start post 10 o'clock. We take liquidity below the kilo, displacement higher causing a market structure shift. The displacement leg has a fair value gap busy near the swing low. We wait for a swing high to form to anticipate execution. For execution, we're looking to enter on the fair value gap rated in the displacement leg that took structure near the equilibrium of the range. You would have been tagged in this trade here at 11:20, breaking even at 12:05, taking out that trade at 12:40 for a total time of 1 hour 20 minutes in this trade. Drawdown in this trade was 44 ticks for a 6% bagged and tagged. Let's consider factors that made this trade a high probability to set up. First, we had the time aspect as the AM session. Check. The range. We're in the middle to lower quadrant. We're in a discount for a buy. Check. Liquidity. Have a M1 liquidity that price comes and takes, and once it takes it, you see immediate reaction to the upside. But we have 3 out of the 3 matching up to make this a high probability to set up. Just going to show you the M1 liquidity right here. It takes this liquidity and then you see immediate reaction to the upside. So 3 out of 3 matching up to make this a high probability trade that netted you 6% for the day. This brings us to the end of tracking IBDA. After 2 losses for 2 consecutive days, I called it for the week and I was done trading after Thursday. It was a week full of L's for me, but I wouldn't change it because it allowed me to unlock a new level of understanding in my model. It is so vital to journal and analyze every trade that you take so you can refine and retweak your model as need be, okay? Thank you guys for watching Tracking IBDA. See you next week. Every week, we have shown you at least 1 or more opportunities that could have netted you 5%. With a 2% risk, if you had taken all 3 trades this week, you'd be looking at 18% for the week. But remember, we're only looking for 1 trade that will net us our 5% and we're done trading for the week. As traders, we must be content with enough and we must learn to limit trade frequency. The less you're in the market, the less of your money it would take. I hope you found Trade of the Day insightful and hopefully you enjoyed this one. Deciding to become a trader is the greatest decision one will ever make. It is the fastest way to build the life that you want. And too many of us fail at it, 90% actually. This is because we're not equipped with the right tools to ensure survival, let alone thrive. There is a way to succeed at trading. Trade of the Day is about showing you how we at I'm the Trader are doing it and how you can do it too. Always remember, this skill is not easy to master, but it's also not impossible. You only fail when you quit. Thank you for watching. See you all next Saturday, same time, same place. Happy hunting.